In prior videos, we looked at fringe benefits and cafeteria plans. Now that you know what fringe benefits are, let's look at the rules we use to value the fringe benefits. After all, payroll accounts must be able to assess non-cash compensation, like a company car, and determine what amount must be included in taxable income. In this video, I'll talk briefly about the general valuation rule for fringe benefits, but we'll spend most of the time on discussing how to value transportation benefits such as a company-provided automobile. There's the general valuation rule, or GVR, which is the most common way to determine the value of fringe benefits. Basically, you're using the fair market value. For the personal use of company vehicles, though, three primary methods exist for determining the taxable income for the employee. One, the least value rule, two, the commuting rule, and three, the cents per mile rule. Let's start with the least value rule. This rule is used when the employee uses the vehicle for work, commuting, and other personal use. IRS Publication 15B provides an annual lease amount for vehicles. For instance, if the fair market value of the automobile on the first date it is available to the employee is $34,850, the annual lease value is $9,250. This annual amount is multiplied by the percentage of the employee's personal use of the automobile, meaning we take the days the car is available divided by 365 days times the percentage of personal use to determine the amount of the employee's taxable income. If the employer also provides fuel, it must be included in taxable income at 0.55 cents per mile of personal use. To practice the least value rule, let's look at the next example. Quinn is an employee of Caribbean Imports. His company car is a 2023 Toyota Prius LXE with a fair market value of $30,000 and a lease value of $8,250, according to publication 15B. During the year, Quinn drove 36,953 miles, of which 6,822 were for personal use. The car was available for use on 250 of the days during the year. All gasoline was provided by the employer and is charged back to Quinn at 0.0585 cents per mile. What is the amount of the company car fringe benefit that will appear on Quinn's W-2 using the least value rule? We start with the annual lease value of $8,250 that is provided in this example. This amount is an annual amount, which means that the employee would be taxed on the entire amount if the employee used the car the entire year and only drove the car for personal reasons, such as commuting to work. In our example, though, the car was only available on 250 days of the year, and Quinn drove 36,953 miles, of which only 6,822 were for personal use. So our first step is to prorate the annual lease amount for 250 days. We do that by dividing 250 days by 365 days, and it tells us that the car was only available for 68.4931507% of the year. Then we find out the personal use percentage by dividing the personal miles of 6,822 by the total miles of 36,953. The result is 18.46128866%. We now multiply the lease value of $8,250 by 68.4931507%, and then multiply it by the personal use percentage of 18.46128866% to arrive at $1,043.19. We also add the cost of the fuel that Quinn's employer paid for by multiplying the personal miles by 0.0585 per mile. The value of the fuel is $399.09, And combined with the personal lease value of the car, Quinn will have an additional taxable income on his W-2 of $1,442.28. Let's look at the commuting rule next. You use this rule when the employee uses the car for work and commuting only. The commuting miles constitute personal use of the vehicle and is taxable at $1.50 per mile. In this example, the employee drives daily commuting miles of 10 miles each way. The employee works 5 days a week for 48 weeks a year, which is 52 weeks less 4 weeks vacation, less 9 holidays. So we calculate the taxable income by calculating first the number of commuting days a year. 48 weeks times 5 days is 240 days, less 9 holidays is 231 days. 231 days times round trip miles of 20 miles equals 4,620 miles times $1.50 per mile is $6,930 in taxable income. Another method to value personal use of the company car is the cents per mile method. However, you can't use the cents per mile rule for an automobile, including a truck or van, if its value when you first make it available to any employee for personal use in calendar year 2024 was more than $62,000. Under this method, you would calculate the miles for personal use and multiply it by the cents per mile rate. There are two additional requirements: the regular use in trade or business and the mileage test. And you can find more details in the IRS publication 15B. The standard mileage rate is 67 cents per mile in 2024 and 70 cents in 2025. Another method for valuing personal use of a company vehicle is the unsafe condition method. This rule applies if a company vehicle is provided to an employee only because of unsafe conditions. The foundation of this rule is that the employee would walk, bike, or use public transportation under normal conditions. In these cases, the IRS specifies that the taxable income is determined by adding $1.50 for a one-way commute. However, there are additional requirements, such as that the employee must be an hourly worker and was not paid more than $155,000 in 2024. In this case, you determine the taxable income by multiplying the number of one-way commutes by $1.50. Many employees, especially in large metropolitan areas, use public transportation. Employers may exclude up to $315 in 2024 and $325 in 2025 from the employee's wages if the employer pays for the employee's transit pass. Let's summarize the rules for valuing fringe benefits. In general, benefits are valued based on the fair market value of the benefits. Basically, what value would an independent, non-related person assign to the benefits that the employee is receiving? For the personal use of company vehicles, three primary methods are used. The lease value rule uses the IRS lease value table to assign an annual benefit amount, which is prorated for the personal use percentage and prorated for the time the car was available to the employee. The commuting rule uses 67 cents per personal use mile to determine the taxable benefit for the employee. Under the unsafe conditions rule, a one-way commute is valued at $1.50, and for transit passes paid for by the employer, $315 in 2024 and $325 in 2025 are excludable from taxable income. A recent development is the Bicycle Commuter Act of 2025, which proposes a tax-free bike and e-bike benefit of up to $81 per month, including shared bike services, maintenance, and charging. This proposal would allow stacking of the bicycle benefit with transit and parking benefits. If passed, the Bicycle Commuter Act would modernize U.S. laws and bring it closer to Europe's bike-friendly policies. I hope you found this video to be helpful and informative.